please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Season 5 of NSE FinWiz powered by CNBC TV18, and I'm your host Nitya Balakrishnan. Today is a very special episode as my team and I have travelled to an educational institution, the Manipal Global Academy of BFSI in Bengaluru.
Manipal Global Academy of BFSI is a leading corporate university imparting quality education in banking and finance. Drawing from its expertise and experience in managing several education institutions of repute, this academy offers holistic training of young minds from across the world to sharpen their core competencies in making a career in the BFSI space. NSE FinWiz arrived at the academy in Bengaluru and met its students to reiterate the importance of focusing on personal finance to secure a healthy financial future.
Efforts like NSE FinWiz are an excellent effort at promoting this financial literacy. It encourages dialogue, it encourages sharing, it encourages the habit that you need to be literate in a common sense of the term. You don't have to go become a technical expert on anything. NSE FinWiz does a wonderful job of connecting people, getting experts down to talk to people who suddenly thought all this was Greek and Latin.
Money is the basic foundation of any human being. So it is but obvious that there are two parts to it. One, you earn, and two, probably invest in secured, sound, return-oriented way. So at the end of the day or at the end of the twilight, you have probably enough money in your coffer.
Wealth management is important. One reason is because it generates a parallel income for an individual. And the second reason, it also helps maintain the same lifestyle post-retirement.
Hello and welcome to Season 5 of NSE FinWiz powered by CNBC TV18, and I'm your host Nitya Balakrishnan. Today we're at the Manipal Global Academy of BFSI, and joining me are Lavai Navlaki and Kalpesh Ashar. Thanks so much for joining us on the show. Well, right away I'm going to say each one of us in this room works hard to make money, but Kalpesh, if you can tell me how important is it for that enabling the money to work for you?
When we say that I save money, what you're doing is just keeping your mind happy with it and having an emotion which keeps you happy that I'm a good saver. But when that saving emotion translates into action, we call it investments. And that action has to be very thoughtful, because that is going to go into a very thoughtful investment which is going to make your money work harder for you. So there's a myth that I'm a good saver. You're not a good saver, you have to be a good investor.
A lot of us set aside an amount of money every month, but where do we park those funds in order to be smart investors?
So mutual funds are a good investment vehicle. They don't necessarily, I know they're youngsters, so typically we tend to tell them that there's long period of time, go into equity, etc. But even if they just went into money market funds, will be a good start, because they're first making sure that they're not spending the money.
So if I were to ask you, is insurance an investment, what would your answer be?
Straight no. So insurance, in our country has always been perceived more as an investment vehicle rather than a pure protection vehicle. And we all have been surrounded by, all these traditional plans and the endowment plans and earlier versions of ULIPs. So those ones are the ones which have actually not let the adequate cover come into the picture of an individual in terms of the life cover, nor 100% has it given any type of returns which you can call substantial or even above average. If you see the returns of these policies in terms of the investment context, it's in a range of anything between 3 to 7%. It's always been that, and that's quite dismal, to say the least. So this is a myth which we need to clear first, and even tell people, spread the word around, that the term insurance policies are the way to go and nothing beyond that.
Absolutely. Lava, if I can ask you to jump in, a lot of us believe that if I'm putting an X amount into an insurance cover, at least, an endowment plan, at the end of the time, even if nothing happens to me, I will get a lump sum back. But is that a smart way of looking at things? Or would you also suggest a term policy where if nothing goes wrong and that's what you want, then it's almost like just setting it aside and forgetting that the money went away?
Yeah, so I think one needs to understand the concept of insurance. The insurance is essentially replacement of economic value of a person. So let's say I am contributing 10,000 rupees every month to my family. If I am not there, imagine, I know it sounds bizarre, but imagine an ATM giving out that 10,000 rupees a month. It won't replace the emotional value, but it takes care of the economic value. If I am contributing that amount, then I want the maximum possible term cover so that I can make sure that that amount is taken care of. So from that point of view, yes, better to take a term cover. If you have lots of money, then maybe you can look at some of the insurance products. There is a tax-free element of it that attracts people. But I think that's not really relevant for people who are just starting their job.
How much percentage of a person's salary, of a person's savings, should actually be set aside to be invested into the equity markets?
I think it's important that people understand when they are investing in equity, that they are looking at it from a long-term point of view, number one. Number two is to make sure that they don't enter the equity markets all at one time. So they sort of stagger it. Just these two simple things if they were able to do. And third, if they had regular savings and money available for investing, then they could make sure that they are entering it on a regular basis. These 2 or 3 things will bring down the risk and then make them get the benefits of equity.
Well, we are chatting in the months of Jan, Feb, March, and this is usually when, you know, the HR across companies in the country will send you mails regarding investment proofs, and then you'll realize, okay, tax exemption is something I should have done and I can do and avail. So let me figure out where to park the funds and then go pick up the first or second or third insurance policy that comes your way. How would you think, is this even smart? How would you avoid this situation if you were a young investor?
So first and foremost, not wait till Jan, Feb, March. This is something that you do at the start of the financial year. Make sure that you put aside enough money for that term policy. Definitely look at your pay slip. If you are in a company which is deducting provident fund, then that's also helping you from tax point of view. So sometimes people go and invest in these tax saving products without realizing that they've already got the tax saving available through their employment. And then they're doing it because somebody else told them that it's a tax-saving product.
All right, on that note, the word coming in from our financial experts is insurance is mandatory, but it's financial protection and not really investment. Stay tuned, we have a whole lot to discuss on the other side.